Good afternoon, everyone. This is Brad Matheny. I'm coming to you on a Saturday after getting most of my work done for my weekend update for my subscribers. And I've gotten a lot of questions recently. So back in July, I think it was May, yeah, it was in April or May, I stopped doing my morning videos and publishing them on Facebook and on YouTube. The reason being, went through a couple of difficult months for me, family in the hospital and such. Everybody's okay now, but a lot of people are coming back to me asking questions, saying, "What are the markets doing, Brad? What do you see?" I talked about gold years ago, back when it was 16, 17, $1,800 an ounce. Told everyone back then that get ready, it's going to skyrocket. Now everybody wants to know what gold is doing. I can tell you what gold is doing, but I'm going to focus on a couple of things today. So basically, I'm going to tell you that people are starting to bug me and ask me questions about how I see the markets and what I see happening. I'm going to show you something right now that I very rarely show too many people. This is the adaptive dynamic learning system. It's a modified AI inference engine that tells us what the markets are going to do. You're looking at an S&P or an SPY 2-week chart. I'm going to focus on these 2-week charts, and I'm going to show you what you need to understand. So last Friday's selling represented this bar. This is 2 weeks ending on Friday. We start a new 2 weeks right over here. The reality is this last selling that we saw on Friday was a nominal move back down into and close to this blue line. The blue line is the predicted aggregate adaptive learning modeling systems output. You can see it is suggesting that the S&P will continue to move up in this manner all the way out here till possibly early January 2026. Now, the way I look at the data, just so you're aware, is I will come in. This is where we originated the data on this bar. I will come in and I will basically draw a channel right across this area. And I will copy that channel and plot it above the price area. So essentially, anywhere in this area is considered normal range. Okay, we can drag this down a little bit here, give it normal range. But if we get out of this range by a substantial amount, notice we're predicting it's going to go up. So if we get out of that range by a large amount, way up here or up here, I would expect price to try to revert back down to this area unless the predictive modeling changes. The predictive modeling changes on every new bar. So you're looking at 2-week chart. We won't get a new bar for another 2 weeks. That's one of the reasons I'm showing it to you. Yeah, it gives you 3 months of predictive data showing you what's going on today, but you won't be able to keep it updated. You won't know if it changes. You won't know what happens on the daily or the weekly or the 60-minute chart. Only my subscribers get that data. I deliver it to them every morning and throughout the day. But now, pay attention to the ranges. So what this is telling you is that we're just going through an extensive lower range. I'm going to mirror off the lower range here, telling you that this lower range is suggesting where price could go within a normal price range event. So we're entering into a volatile period here, have been for the past 2 or 3 or 4 weeks or months, rolling through this volatile cycle. We move into a fairly narrow event cycle right here over 2 or 3 weeks. That's going to be around the end of October, early November, and then we move into a very volatile period where we have a range from the upper range to the lower range of approximately 12%. And we are looking at the potential that any act of God or unusual event could change the way the market operates and could move us into a very strong downtrend. Now, remember, my adaptive dynamic learning system is an aggregate learning model. It discards data that is irrelevant and it aggregates the data that is relevant using a quantitative modeling system to try to identify the most logical price outcome, ignoring what I would consider price voids, price anomalies, active gods, active government, active war, active nature. So hypothetically, we can make a prediction about what's taking place or what's likely to take place without having some underlying or outlier event causing the markets to disrupt. If we were to get a disruption, we would see price move outside of these channels. These, I'll make them yellow. These channels here. If we were to get an active God type of event or an unusual price outlier, we would see price move downward below this level into this lower channel. And if it got below this lower channel, if we were to see price move from here all the way down into this area here, this would be what I would consider a major outlier event taking place. Make it kind of a dark pink color. This would be a major outlier event and would likely crush the market downward as a breakaway trend. Now, how do we adapt these breakaway trends? The predictive modeling system cannot identify the breakaway trend in an active God or an active war, an active government type of event. It doesn't identify those. We cannot predict those. What it does do on the shorter term charts, 5 minute, 10 minute, 30 minute, 60 minute, is it identifies the immediate breakaway trend and attempts to start predicting the data based on that breakaway trend. Now, if it's an unusual block of data, meaning we haven't learned sufficiently enough data to make decent predictions, we will continue to see this breakaway event take place. So, for example, in a downtrend, we may have predicted this move here through an event cycle like this, where we have the range, we have the predicted model, and it stayed within the range. If that breakdown persisted into a deep downward cycle, and again, I'm at a Starbucks, so you're going to hear a lot of kids and people running around, which is fine, then we cannot identify this downward cycle trend as clearly as I would like. What we can do is continue to identify that we're outside of the range, below the range level here. This would indicate that we're in an outlier event cycle. As long as we stay outside of that predicted range, as the range changes going forward, then we are continuing the outlier breakdown event. We stay in this outer area outside the boundaries, then we're continuing to move downward. It's that simple. Okay, so what this is saying is the S&P right now will likely move into and rebound upward as we move higher here. It's likely to stay in this upper range. We have right now potential to move down here. This week is ending. We're going to this week. The lower range is 643, 644. The middle range is 650, and the upper range would technically be up in this area, 671, 673, and we're likely to get a moderate bounce over the next couple of weeks, maybe moving up into the 670, 665 area or higher. Now, if we move into this week by, say, November, let's call it November 5th to 10th, we're going to be in this big volatile range right here. This is going to tell us that price could move down into this lower channel, 581, 575, 590, and really move into a big breakdown event before the end of the year. And this could come in the form of a news event, a economic collapse, war, whatever. It could be a tightening of Q4 earnings data or a tightening of consumer activity. But this is telling us we're moving into very broad volatility right here with a 12% range. This is huge. You need to be aware of this. Now, let's take a look at something else so you can see how this works from a different standpoint. We're going to now take a look at the QQQ. Get rid of that. Clear some data here. Here's the QQQ data. You can see that we're already above the upper channel. Okay, this means that we theoretically, in order to identify a recovery, would move down into this channel here somewhere, or we could stay still up in this upper channel and push higher. But notice the range that we have between here gets bigger and bigger all the way out to this breakdown event right here. This is out into January, okay, January, February 2026. So we have essentially price for the next 20 to 30 days. We have price staying within this sideways channel, somewhere between, let's call it 601 and 565, trading sideways into a sideways channel into November and into December, going forward through the end of the year. Okay, so now what does this mean? We could see from any point, for example, right here, we could see a 5-point to potentially 7-8 point contraction in the market, whereas an upward move in this market would put us only about 4.5 to 5.5% higher from where we're at right now through the end of the year. So QQQ has moderate 4.5%, 5.5% upside potential, and it has approximately 7 to 8% downside potential. Okay, let's go take a look at IWM, the Russell 2000. I want you to see how this works. Russell 2000 looks like it's going to potentially push upward, follow the levels. So we come from here up into this area, possibly about 6 or 7% over the next, call it 2 months. And we have a downside risk of potentially 10 to 14%, let's call it 10 to 15% to the downside. We are overextended at the moment. I would think that the most logical conclusion is that we're going to consolidate sideways, maybe a little bit downward, and then base in this area, maybe a little further down, and then try to move up here. The blue line, remember, tells us what the dominant price trend should be based on historical price modeling using my quantitative modeling and inference engine, which is, again, like AI. So what we're looking at here is sideways trending and then a potential rally into November, December, telling us that maybe into January we could get kind of a dip here. Okay, but we still have this very wide volatility. So remember, we have from this point here to this point here, we've got a almost 18 to 20% range of price volatility going into Christmas, into the end of the year. Okay, so let's take a look at Bitcoin. All right, waiting for it to load. Bitcoin suggests that, again, upper range, lower range, blue line suggests that we're really looking at a moderate sideways trend in Bitcoin, kind of along this channel. This would mean moving down to about, 115, 110 on actual Bitcoin itself. And then over here near the end of the year, moving into a fairly strong rally from this area here up into the 130, 140K area over here. So towards the end of the year, at this point, it looks like we're going to get a very strong rally from potential lows, maybe in 100,000 area or below, maybe 95,000 area, and then shoot considerably higher. Okay, this tells us that right around end of November, December, we could be moving substantially higher up into 130, 140, maybe 145 area. Okay, again, we get very broad volatility. So pay attention to the range between here and here. 22% volatility. If we carry that over to Bitcoin, that means you could be moving from, $100,000 to 125,000 or 130,000, roughly a 20 to 30% volatility range at any time over the next, call it 5 to 7+ weeks. Okay, let's come over and take a look at gold. And again, the reason I'm doing this for you is because so many people are out there telling you what's going on, trying to tell you what's going on. Now, we are in an anomaly event in gold, so I will explain this to you. We have never seen price appreciation like this in history of GLD. Going all the way back here, we have never seen the history, and this goes back to 2006. So throughout the entire range of this chart, even through this price appreciation, we do not have any movement like this to correlate. Well, we have some, but nothing correlating to the aggressiveness of this move in gold. What I can tell you here is that we've been seeing this type of upward outside anomaly. So understand, like I showed you earlier, the way I would do this, or the way I interpret this, is I mirror a channel in gold. And what I try to do is I try to mirror the channel. This is what I call the standard deviation channel. And I do this visually, and we are outside of the range. Drag this down a little bit. We're outside the range. We're in a price anomaly. This tells us that gold would consolidate. I believe that gold will possibly reach a peak up in this area and then consolidate downward back into this lower range, maybe down to this area. You see how the upper range and lower range consolidate here? This gives us a consolidation channel. This would be roughly, let's call it 3,600 to 3,900 in gold, whereas right now we were above 4,000. So again, but what that tells me here is near the end of this month, early November, maybe mid-November, we're going to move back into an acceleration phase, which could be extremely aggressive. Now we're going to get basically a 2 to 3 week, maybe 4 week pause in gold before and it's likely going to come down to 3,600 to 3,900 to try to base in this area, and then it's going to take back off. And this is where we're likely going to see it move up to 5,100, 5,000. Okay, let's go to silver. And what is the value of this? Well, imagine every day you had new predictive data telling you what's going on. And every day you could determine what's happening in the market by understanding what's happening with the data. It's fairly simple. It's data driven. It's factual driven. I try to help you in my research. I try to help you interpret it. and help you stay ahead of it. You know, for example, no one will believe me, but I have been calling for a market top now, let me find it here, for weeks. You don't believe that I've been doing it, I'm sure. Most people won't, but take a look at my updates. 921. We're going to see weakness, market strength. Gold and silver only have about 2 to 3 days of upward trending before moving to a stalling pattern. That was 921. It's near September 18th, 19th, I believe, gold will begin a new rally phase targeting 4,100 to 4,300. Okay, remember guys, that was a month ago. And what did gold do? What did gold do? It went from this level back here, this is silver, all the way up to 4,100, just like I told people. So now, what am I telling you here? 928. This was, what, 2-3 weeks ago. So here, expect a very quick rally over the next 3 to 5 days, but prepare for a peak before October 7th, 2025. Okay, I'm telling you before the end of September that in 2 weeks, prepare for a peak. Now, my research becomes more clear. Look at here. This is the last week's update. This is, again, a week ahead of time. Expect a very quick rally over the next 3 to 5 days, but prepare for a peak near October 7th through 12th, 2025. I continue to see signs of weakness in the market, yet I won't fight this uptrend. Traders should stay efficiently hedged going forward. While I still believe healthy cash reserve is essential, it appears the SPY will target levels of 670 to 680 over the next 5 to 10 days, seeking a top end of wave structure. Gold and silver have made a dramatic move higher. I believe there's a chance to see 4,100 to 4,300 before October 7th through 15th. So we got to almost 4,100 last week before we get this roll down. Now look at how clean this is. This is telling you 2-3 weeks in advance what is likely to happen. And now hedging, like I suggested right here, traders should stay hedged, efficiently hedged, worked out beautifully on Friday. All of my hedging positions ended up being profitable. I pulled half the positions off and I left half the positions on for this week. I did add a couple of what I would call lotto trades at the end of the day on Friday, yesterday. I picked up some SPY calls and some SSO calls. The purpose behind that is if my predictive modeling system, and I'll get back to silver in a minute, but if it says that we're going to reach a base, reach a bottom, and maybe bounce, hey, I'm in that ride. I will take a trade on a speculative bounce. I just won't make it a huge trade. You understand? The idea here is not to bet the farm, but to try to make a good, healthy 30, 40, 50% profit trading options. But now silver, what is silver telling us? We're in an outlier event cycle. We're breaking down. It looks like we could be breaking down to the downside. I would interpret this as silver being extremely overvalued right now, potentially moving back down into probably a 382 to 50% retracement area. That would mean silver could move from the 49.50 to, let's say, at 49.50 to $51 area, could move back down into the $46 area on some panic selling, and then I think that we are likely going to base, and I think that we are going to move upward very aggressively, continuing in this outlier mode. So this is an area where the predictive modeling system doesn't have any real data telling us that markets are going to predict a much higher move. What it's telling us is that we're outside of the event, we're continuing the outlier event, and until we move back into this middle structure area, which may not happen for the next 2, 3, 4 months, we continue to be in an outlier bullish cycle. This is telling us that we're breakaway bullish, and that while we stay in breakaway bullish, you should be predominantly buying cycle lows. We're in a big breakaway trend, and until we end this move and start to consolidate downward, you should continue to chase this upward. It hasn't failed yet. It may eventually consolidate, but I believe it's going to continue to move higher. So let's go ahead and look at maybe the transportation index, see if I missed anything here. IYT. And remember, I'm giving you this information because I want you to see that, what can be done with advanced modeling. There's a lot of people out there that will give you feedback, and of course I will as well if you become a subscriber, but it's important for you to really understand where we're at with this. So where we're at with IYT is that we are now in a predictive breakdown mode, and this means that the economy is going to weaken into the end of the year. Theoretically, we're above the zone already. We should be reverting from this area back down to this area, and we should be looking at a moderate contraction in the market. It may take time to revert back down, but eventually we will likely revert back down into this gap zone back here, stalling, and that represents, again, on the transportation index, a move down 5 to 8.5%. A move down 5 to 8.5% in the general market. Again, this is the general market, not the SPY, not the QQQ. That means the economy could continue to tighten into and through the end of this year. So remember, end of this year is really right over in this area. So we're going to be looking at potentially moving into an end of year contraction, moving into an early contraction in 2026, finding some support in early 2026, which will probably be the Q4 earnings, and then possibly moving into further contraction further out. Now, predictive data further out like this becomes very unreliable. 20, 25 bars, in this case, 2-week bars, out in the future becomes moderately unreliable. Only about 20 or 30% reliable. But still, the first 5 to 10 bars is about a 70 to 80, maybe 85% reliable. And again, remember, this changes with every new bar, potentially changes. So we get new data, new aggregate correlative data with every new bar. Right now, this is telling me that we're likely to come down, likely to see continued economic contraction, which would continue to drive growth in metals and would continue to potentially drive growth in the US dollar and continue to potentially drive growth in the major indexes, the SPY and the QQQ. And now why would growth continue to drive in the SPY and the QQQ? If the dollar continues to hold up as a safe haven hedge, the same thing with metals, then global investors will likely be moving very aggressively into US-based assets to hedge against global economic risk. So understand that this is a move to safety. This is not a US collapse. It is a move to safety while global markets potentially weaken. If global markets could potentially weaken, capital will move into the US markets likely, and possibly the European markets, particularly Great Britain or the UK, simply because we are the most dynamic economies on the planet. We are the most likely to withstand any type of global weakness or any type of market collapse throughout the globe. And so dollars and investment capital will seek safety and security, which is going to be in the UK or US markets, in my opinion. Okay, so there you go. The point being, if you really want to change your trading, you want to see what advanced tools like predictive modeling are about. Now remember, I'm not going to show you everything that my members and subscribers get. I'm sharing with you longer term research I'm not going to come out here and flip my analysis back and forth like other people do. I'm not going to try to sell you on this or that or the other, or provide you the next great hottest trade. If you want to know something, then I'll tell you this: buy gold. Buy gold and silver and prepare for a good solid rally. I will tell you this, that by early 2026, gold and silver are going to have reached a peak, and you are going to see a 4 month to 6 month stagnation in gold and silver. That's really going to frustrate the hell out of people, and they're not going to know what to do. So you've got maybe 2 or 3 months of rallying, maybe not even that much, maybe into early November, early December. You've got a decent rally coming up in gold and silver. But after gold reaches its peak, you've got 4 months to 6 months of sideways consolidation, downward type trending. And it's going to frustrate the heck out of everybody because no one knows it's coming. But I do. I know it's coming from my modeling systems and my own research. So you can prepare and you can make money when it's there. And then once we get the top, I will be telling people how to trade gold and the SPY through the consolidation period to learn how to make the most money you can through these big broad swings. And if you don't understand what's going on, I've got a client that just turned her account from 2.3 million to 4.2 million in the last 35 days trading gold. Very aggressive. She knows what she's doing, but she's following my research. That's a huge improvement, guys. That's an 80% return on investment in 35 days. You don't believe me? You can go talk to her inside my member area. She's kind of private, but she shares details about every 10-15 days, and she's just been killing it. So here's the point: if you want to try something different, if you want to learn why the markets do what they do and how my modeling systems and research are different, come over here to Ment.com. Let me go over here. Come over here to Ment.com and take a look at what I do. I'm not here to rip you off. I'm not here to teach you how to lose money or flip my analysis day after day. I'm here to give you the tools and the research and the knowledge to become a better trader. And that's really what it comes down to. If you don't like it, you can go find somebody else. But the real reality is the people who stick with me are the ones who want to learn how to improve their skills, not the ones who are looking for the hottest trades, every 2 or 3 days and blow out their account every 2 or 3 days. This is about consistency. This is about sticking with the trading style that works. This is about building your own skills so that you can manage your life and your future with or without me. It's not that hard to do. You just got to stick with it for a period of time and follow my research. I don't give away my tools. In other words, the predictive modeling is very private. It's not something I share very often. And the reason being is because it can give a lot of information. I've just shown you what these markets will likely do over the next 60, 90 days. So think about it. Knowing what's coming, even having an inkling, an estimate of what's coming, it's better than just guessing at what's coming. And that's what all of my research is about. I use data to show me what is likely to happen, not guess at what is likely to happen. And from there, I make my trading decisions based on what price actually does. So if you're ready to try something different, come over to Ment.com and check it out. All right, guys, have a good week. Have a good end of the year. Talk to you later.